VTI is the Vanguard Total Stock Market Index Fund ETF, and it is an absolutely behemoth of a fund. It is huge. VOO. VOO is the Vanguard 500 Index Fund ETF. Actually, it's also very huge.
Holy moly!
So really what we're talking about today is two, honestly, behemoth ETFs, some of the most popular ETFs that there are available. Okay, I am trying to figure out and think and put myself in the shoes of the viewer on this one. Okay, here's what I think. I think some of you watching this video are probably looking at these two ETFs and you're splitting hairs probably. You're probably putting in a lot of work and analysis and time to figure out which of these is the best, when in reality, they're not that different. A bold statement from a guy who's about to try to have you watch this whole video, but I do think, this video is going to be helpful. It's going to help you understand how similar they are, but at the same time, I think hopefully you'll get an understanding and be able to make a decision after this. But what I don't want people to watch this to do is get paralysis by analysis on this one. I don't think that it's worth putting in too much time and effort into figuring out if you want VTI or VOO. I think they're so similar that at the end of the day, it probably doesn't matter that much. Now, that being said, let me back this up with the discussion about what we're going over here. So let's start with comparing these two ETFs. So here on the left, we have VTI, the Vanguard Total Stock Market Index Fund ETF shares. Here on the right, we have VOO, or the Vanguard S&P 500 ETF. Okay, let's start off with the expense ratio, of course. And the expense ratio for these are the same. 0.03% is the expense ratio for both of these ETFs. Essentially, you're paying no money for them. That in dollar terms, so $100,000 invested in this ETF at 8% over 10 years is going to cost you $451 over 10 years. So honestly, not going to cost you a lot of money to hold this ETF over a 10-year period of time. Vanguard is in a business apparently that is, how do they make money is what I'm wondering. $451 over a 10-year period. That's nothing. For all the dividend investors out there, these do have some yield on them. So VTI is 1.50, VOO 1.57 for the 30 days. So the shorter term yield when we look kind of in a shorter time period. And it's essentially the same as a general distribution yield. These pay quarterly dividends. So quarterly distributions are going to be paid out of these ETFs. VTI has 4,059 holdings in it. Holy, that is a lot of different stocks to be in one ETF. And then we have VOO, 506. So the deal is, okay, they're both very diversified, 506 different holdings. That is a very diversified ETF, but then 4,059, that is just a ton of different holdings in it. Now, here's the kicker on this one. If we go down to the top 10 holdings, so because these are market cap weighted ETFs, the ETF, they invest, the most money goes into the largest companies, basically. So what that ends up doing is it makes it a very similar, let's say, top 10 holdings for this ETF. So VTI has 23.27% of the whole fund in the top 10 holdings, and then VOO, 27.56% of the holdings in the top 10 holdings. And if we look at the top 10s, we're going to see a similar amount of money that are going to be in each of these. So we have Apple at 6.1%, Apple at 7.2%. Not a big difference, just a little bit more than the percent difference in Apple. Microsoft, same thing, pretty close. Amazon, pretty close. Tesla, pretty close. Google, Class A, pretty close. Google, Class C, pretty close. UHC, United Healthcare. Then we got Berkshire Hathaway, but then they're inverted here, so they're all kind of similar top 10 holdings. And when you add these all up, you're going to get 23-point-something% for one and 27-point-something% for the other. And what does this even mean? Well, it means that there's a lot of overlap in these two funds. In fact, if we look at the actual overlap, we can see 84% of the weighting of this entire portfolios are the same. So you're not getting a huge difference, only like a 15% difference in the whole portfolio, even though VTI has 4,000 something stocks because the smaller companies have less weight in the portfolio because it's market cap weighted. So what you're really getting is you're getting everything that's inside of VOO, inside VTI, of course. But in VTI, you're getting a little extra stuff. And then, of course, down here, we could see the differences between the two. So when this is positive, this means that VTI has more industrials, it has more real estate, and it has more financial services and materials, but there's not a lot more. Only 1.3% more in industrials, for example, that are inside of VTI. Down here, we could see VOO has 1.3% more in tech. So VOO has more tech, it has more communication services, more consumer staples, more healthcare, and more energy. So, okay, look, if you want to really split hairs on here and you want to decide, okay, which of these do you like, based so far on just the sectors that have more weightings, which one? I like VOO's sectors more, actually. It's got more tech, it's got more consumer staples, it's got more healthcare, and it's got more energy. I like those sectors more than these, although I do like financial services right now. But in general, that's the deal with this part. Okay, let's take a look at the returns. As expected, the returns are very close for these two ETFs, of course, because there's so much fund overlap in these. So if you go back and you look back until, let's say, September of 2010 to the present day, you could see VOO slightly outperformed VTI, 308% gain versus a 294% gain. Yes, there's a little bit better of a gain for VOO than VTI. Now let's pull this thing forward and see what happens over time. So over time, let's see if VOO is able to cross under VTI, meaning that VTI ends up being a little bit better. Does it ever happen? And let's see what happens as we continue going forward in time. And so far, it does not look like anything is going to happen, and no. So maybe in the past week. So essentially, if you go back over all this time period, VOO always outperforms VTI. So at the end of the day, does that mean you should invest in it? It doesn't necessarily mean anything. Past performance is not indicative of future returns, of course, but if I did have to pick one of these, and I'm already going to kind of talk about which one I would personally pick, it's essentially going to be based on two different factors. First off, do I think small cap and mid cap stocks are going to outperform large cap stocks going forward from here? And then two, which sectors do I like more? I think that it's more important to know about the small and mid cap stocks than the large cap stocks first off, so I would weight that decision more. Do you have an opinion on that? If you think one's going to do better than the other, that might be the thing that helps you decide. So for example, if you think small and mid cap companies, so the smaller companies in the stock market, the middle-sized companies in the stock market, are going to do better than the larger companies, the companies that are in the S&P 500, the Apples, the Googles, the Teslas. If you think that's going to happen, then you might want to go with VTI. Basically, that's just because that 15% that is inside VTI that's not inside VOO, they're going to be the smaller companies. And so if those end up doing better, VTI is going to do a bit better. Now, if they don't do as well, VOO is probably going to do better. So if larger companies outperform the smaller and middle-sized companies, then you're going to have VOO doing better. Which do I think will do better over a long-term period of time? I think the larger companies are going to do better. What do I think will happen over the shorter-term period of time? I think smaller companies and mid-sized companies have a potential to outperform large caps in a short-term period of time, not a long-term period of time, but a shorter-term period of time. And time will tell what happens, but in a recessionary environment, maybe that we might be going into a more bear market, negative type of environment, the small and mid might actually do okay. So at the end of the day, my decision would be made on what I think about that. And also, I don't think it's that big of a deal if you're splitting hairs here and you're putting a lot of time into trying to figure out which of these. Honestly, eeny, meeny, miny, moe it, and at the end of the day, you're probably going to be fine. So anyway, let me know. Do you agree with me? Do you think this is actually a really big, important decision, or do you think these two are so similar that it really doesn't matter that much? Let me know in the comments. I would love to hear from you. And if you like this video, hit that like button, subscribe to see future videos like this. And got another video coming up on the end screen. Please watch that right now. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.